Listen to me very carefully, because I'm only going to say this once, and what I'm about to tell you is worth more than whatever you paid your last financial advisor, which, knowing most of you, was probably too much for advice that made you absolutely nothing. Gold has exploded 3 times in the last 100 years. 3 times it has gone from being something people casually ignored to something that made certain investors generationally wealthy, and wealthy almost overnight. From $35 to $850, from $250 to $1,900, from $1,050 to nearly $4,800. And every single one of those moves, without exception, without a single miss, was preceded by the exact same 4 signals. Not most of the time, not under the right conditions, every single time. And right now, today, as you sit there watching this video, all 4 of those signals are flashing simultaneously. This isn't a prediction. This is pattern recognition backed by nearly 100 years of hard financial history. And if you are not paying attention right now, you will spend the next decade regretting it. If you are watching this channel for the first time and you think this is just another financial YouTube channel with somebody trying to sell you something, let me be blunt with you. You are wrong. And your skepticism, while I respect it in principle, is going to cost you money. The information on this channel is the kind of analysis that institutional desks charge thousands of dollars a month to access, and you are getting it for free. The only price is a subscription, and if you are too stubborn or too lazy to click that button, then frankly, you deserve to miss what's coming. Subscribe now, because what I'm about to walk you through, the 4 signals, the historical proof, and exactly how to position yourself, is the most important financial briefing you will receive this year. Let me start with signal number 1. And I want you to understand this not as an abstract economic concept, but as a cold mathematical reality that has played out with brutal consistency across nearly a century of financial history. The signal is this: government debt reaches a point of no return. And I want to be precise about what that phrase means, because there is a critical difference between debt that is large and debt that is mathematically impossible to repay. When debt crosses that second threshold, governments do not have a menu of options. They have exactly 2 choices, and both of them are ugly, and one of them is politically impossible for any Western government to choose. The first option is outright default. You simply tell your creditors that you cannot pay them back for a banana republic, for a country with no global reserve currency and no institutional credibility. This is painful but survivable for the United States government. It is political suicide, economic catastrophe, and a global confidence collapse all happening at once. No serious American administration is going to stand in front of the world and say, we cannot pay our debts. It has never happened, and it will not happen. So that option is functionally off the table, which means there is only one remaining option, and that option is to quietly, systematically, and deliberately make the currency worth less. Not worthless overnight, worth less, gradually, methodically, until the debt burden becomes manageable again in nominal terms. Even though in real terms, every single person holding dollars has been robbed. Now let me show you how this is played out in practice, because I'm not asking you to trust a theory. I am asking you to look at documented, verifiable, irrefutable history. Go back to the 1930s. America had just come through World War I and was drowning in the Great Depression. Government debt had exploded through the roof. There was no way to tax their way out of the hole, and no economic growth sufficient to grow their way out either. So what did President Franklin Delano Roosevelt do in 1934? He signed Executive Order 6102. He did not ask Congress. He did not hold a national debate. He simply made it illegal for American citizens to own gold, ordered them to surrender it to the Federal Reserve at a fixed price of $20.67 per ounce, and then, once the government had collected everyone's gold, he revalued it to $35 per ounce. That is a 69% increase executed on gold that the government had just confiscated from the public at the lower price. Think about the audacity of that maneuver for a moment. The government stole your asset, repriced it upward by 69%, and kept the profit. And what happened to the people who were holding dollars instead of gold? Their purchasing power was decimated because the dollar's reference point was gold. And gold had just jumped 69% overnight. The dollar holders got robbed legally by their own government. and most of them did not even fully understand what had happened to them. Fast forward to 1971. America had been spending recklessly, Vietnam, the Great Society programs, a government writing checks that the economy could not cash. The debt mathematics had broken again. The spiral was the trigger. And Richard Nixon went on national television on August 15th, a Sunday in the middle of August, when as many Americans as possible were on vacation and not paying attention, and he announced that he was temporarily suspending the gold standard. That temporary suspension has now lasted 55 years. Once the anchor between the dollar and gold was severed, there was nothing stopping the government from printing as much money as it wanted. The dollar dropped 30% over the following decade, and gold went from $35 to $850. That is a 2,300% move. Let that number sit with you for a moment. 2,300%. And then move to 2008. The dot-com bust had already done damage. Iraq war spending had piled on, and then the housing market imploded because a generation of irresponsible bankers had built a mountain of structured garbage and called it financial innovation. The government's response? They backstopped the banks, the insurers, the mortgage companies, all of it, and debt doubled almost overnight. Gold went from $250 to $1,900. Today, the United States national debt is approaching $40 trillion. That is close to $300,000 per American household, which is 6 times the average household income in this country. Nobody is paying that back. Nobody's even pretending they're going to stop adding to it. The debt mathematics have broken again, exactly as they have broken every single time before. And every single time before, signal 1 was followed immediately by what comes next. Signal number 2 is the one that most people miss entirely because they are not watching for it. And by the time it becomes obvious, the move in gold has already begun, and they are buying at the top, wondering why they missed the bottom. The signal is this: when the debt math breaks, governments do not announce it honestly. They change the rules. They restructure the monetary system through executive orders, policy announcements, regulatory frameworks, and technical financial mechanisms that sound boring enough that most people do not bother to understand them. And while those people are busy not understanding, the people who do understand are repositioning their wealth. So, wealth, let me walk you through the 3 clearest examples of rule changes in modern financial history. The first is the most brazen: FDR's gold confiscation in 1934, which I've already described. But I want to add the enforcement dimension because it is important. If you were an American citizen caught holding gold after Executive Order 6102, you faced a fine of $10,000, equivalent to roughly $200,000 in today's money, or 10 years in federal prison. The government did not just change the rules. It criminalized the ownership of real money and backed that criminalization with severe penalties. That is not a subtle policy adjustment. That is a government so desperate to control its monetary situation that it is willing to imprison its own citizens for holding gold. The second example is Nixon's 1971 announcement, which I've referenced, but I want you to understand the framing of the lie that accompanied it. Nixon did not stand up and say what was actually true, which was that the United States had printed so many dollars that it no longer had sufficient gold reserves to honor its international obligations under Bretton Woods, and that foreign governments were converting their dollars to gold at a pace that was rapidly draining Fort Knox. That is what was actually happening. Instead, he called it a temporary suspension and wrapped it in language about protecting the dollar from international speculators. The rule change was massive. The entire monetary architecture of the post-war world was dismantled in a single Sunday night speech. And the people who recognized what had actually happened, not what Nixon said had happened, and moved their wealth into gold, were rewarded with a 2,300% return over the following decade. The third example is 2008 to 2010. And the rule change here was the invention of quantitative easing. The Federal Reserve did not want to call what they were doing printing money, because printing money sounds inflationary and irresponsible. So they invented a new name for it: quantitative easing. What does quantitative easing actually mean? It means the central bank creates trillions of dollars out of nothing and uses those manufactured dollars to purchase financial assets, mortgage-backed securities, treasury bonds, whatever needs to be propped up, effectively bailing out the people who caused the crisis, using money that did not exist before the crisis. They changed the rule that said money has to be earned or borrowed They simply decided they could manufacture it. And gold doubled. Now look at what is happening today, right now, in 2026, and tell me this does not look familiar. The US government has passed something called the Genius Act, which requires stable coins and digital currencies to be backed by US government debt. Read that again slowly. The government has passed a law that forces an entirely new asset class, the cryptocurrency ecosystem, to purchase US Treasury debt as a backing mechanism. They are using financial regulation to manufacture artificial demand for government bonds, which is another way of funding the deficit through the back door without having to print money in a way that the headlines will notice. And simultaneously, the Federal Reserve is cutting interest rates while inflation remains elevated. The exact opposite of what basic monetary economics says you should do, because the debt servicing costs of $40 trillion at high interest rates are simply unsustainable. Every single time in history, the governments have changed the rules this extensively and this desperately. Signal 3 followed almost immediately. Signal number 3 is where it becomes personal, because this is not happening to abstract institutions or foreign governments or people in economics textbooks. This is happening to your bank account right now, today. And if you do not understand the mechanism, you will continue to believe you are being financially responsible while you are actually getting poorer every single month. The signal is negative, real interest rates. And here is the mathematics of it in plain language. Your savings account pays you somewhere between 2% and 4% annually, depending on where you bank and what kind of account you have. That sounds like growth. That sounds like your money is working for you. But now account for what is actually happening to the cost of your life, your groceries, your rent or mortgage, your utilities, your insurance, your health care. These costs are not going up at 2% per year. They are going up at a minimum of 6% annually. And for anyone living in a major metro area or carrying any significant cost of living, the real inflation rate on your actual expenses is considerably higher than that. So let me do the arithmetic for you, because apparently nobody else is going to. You have $1,000 in your savings account. Your bank gives you 2%. So after 1 year, you have $1,020. Meanwhile, inflation at 6% has reduced the purchasing power of your money by $60. Your balance shows $1,020. But in terms of what that money can actually buy, you're at $960. You have lost $40 in real terms in a single year while doing everything that conventional financial wisdom told you to do. You saved, you were responsible, and you got poorer. That is not an accident. That is a feature of the monetary system, not a bug. Now understand what happened after Nixon's 1971 move, because the 1970s are the historical template for what we are experiencing right now. After the gold standard was severed, inflation in America climbed to 14%. 14% annual inflation, while savings accounts and bonds were paying considerably less, and the people holding cash and fixed income instruments were being destroyed in real terms year after year. And the majority of them did not even understand why their standard of living was declining, despite the fact that their bank balance appeared to be growing. And after 2008, the Federal Reserve took interest rates to essentially zero, while the government was simultaneously running massive deficits and expanding the money supply. This meant that pension funds, which are legally required to hold significant portions of their assets in treasury bonds and other fixed income instruments, were being told by the government to lend it money and get back less purchasing power than they lent. The government was legally robbing pension funds, and it was doing it slowly enough and through enough layers of financial complexity that most pension holders did not realize it was happening until they were already short. During that period, from roughly 2008 to 2015, gold went from $800 to $1,900. The people who recognized that cash was melting moved into real assets, hard assets, physical assets, things that cannot be printed or manufactured by a central bank. And they preserved and grew their wealth while everyone holding cash and bonds got quietly, legally impoverished. Where are we today? The Fed is cutting rates. Inflation remains elevated. The pattern is identical. And when people finally realize, en masse, that their savings are melting faster than their bank statements are showing, they look for an alternative. And that search for an alternative triggers the final signal. Signal number 4 is the one that, in my experience, is the most conclusive confirmation that a major gold move is underway. because this signal does not come from retail investors panicking or financial commentators making predictions. This signal comes from the people who know exactly what is happening to the value of paper currency because they are the ones responsible for managing it. The signal is central bank gold buying, and it is the institutional vote of no confidence. In the paper monetary system, think about what it means when a central bank, an institution that has a legal authority to print its own national currency, starts exchanging that currency for gold. They are telling you, through their actions, rather than their words, that they believe the currency they are creating is worth less than the physical metal they are acquiring. They are not saying this in a press conference. They are not publishing a report titled, "Our currency is overvalued and gold is a better store of value," but they are acting on that belief with billions of dollars of institutional capital. And if you are paying attention to what central banks do rather than what they say, the message is unmistakable. Before 1971, you could already see the cracks forming in the Bretton Woods system. France, Britain, and Switzerland were converting their dollar reserves to gold as rapidly as the US would allow, because their finance ministers and central bank governors could see that the Americans were printing more dollars than they had gold to back, and they wanted to exit the dollar before the inevitable repricing. They were right. After 2009, something remarkable happened that most financial commentators either missed or underreported. Central banks, as a collective, flipped from being net sellers of gold to net buyers of gold for the first time in decades. Emerging market central banks, countries that had spent decades building dollar reserves as a sign of economic credibility, started aggressively accumulating gold instead. This was not a small shift. This was a fundamental reorientation of how sovereign wealth managers were thinking about reserve assets. And it was the institutional recognition that the post-2008 monetary experiment of zero interest rates, quantitative easing, unlimited deficit spending was a confidence game that was eventually going to have consequences. Today, central banks have been net buyers of gold for 15 consecutive years. In 2025 alone, they purchased approximately 1,000 tons of gold. Poland, China, India, Turkey, Kazakhstan, the Czech Republic, country after country is diversifying away from dollar-denominated reserves and into physical gold. Goldman Sachs, not exactly a fringe institution, has called this the most aggressive central bank gold buying cycle in modern history and has projected a gold price of $5,400 per ounce by the end of this year. Now, I want to be clear about what Goldman's price target means and what it does not mean. It is a projection made by analysts working from available data, and projections are always uncertain. But Goldman Sachs is not making this call to be contrarian or to attract attention. They are making it because the four signals that have preceded every major gold move in the past 100 years are all simultaneously present. And they are doing the same pattern recognition that I am walking you through right now. And they are arriving at the same conclusion. Now let me tell you how I think about positioning, because analysis without action is just expensive entertainment. And I want to give you the honest version of this, not the version that tells you gold is going to make you rich by Thursday, because that version is a lie, and the people selling it to you are not your friends. Gold is not a get-rich-quick trade. The 1970s move, which produced a 2,300% return, took 9 years to complete. 9 years. And within those 9 years, gold dropped 47% between 974 and 1,976, a 47% drawdown right in the middle of the largest gold bull market in modern history. If you had bought gold in 974 without a risk management framework, without position sizing discipline, without the psychological fortitude to hold through a 47% loss, you would have sold at the bottom and missed the subsequent move that made investors wealthy. This is the information that the people talking about gold on social media never give you, because it is not exciting and it does not get clicks, but it is the most important thing I can tell you about how to actually profit from what is coming. My framework is a 4-asset class structure, and it has served sophisticated investors well across multiple market cycles. You need equities, because over long time horizons, productive businesses create real wealth, and equities remain your highest return asset class in normal conditions. I am still allocating approximately 50% to 60% of a well-constructed portfolio to stocks. You need bonds or a bond alternative, though I want to be honest with you that traditional fixed income is deeply unattractive in a negative real rate environment. And you should think carefully about what function bonds are actually serving in your portfolio right now. You need real estate if your capital base allows for it, because real property is a hard asset that historically performs well during inflationary periods. And you need metals, which right now means primarily gold. And the allocation question is not a fixed number, but a function of your conviction, your time horizon, and your risk tolerance. Many serious analysts are currently suggesting 10% to 15% in metals as a portfolio hedge. I think the environment warrants consideration of a somewhat higher allocation, but I am not going to sit here and tell you to go all in on gold, because anyone telling you to go all in on any single asset class is either reckless or trying to sell you something. Within the metals allocation, you have three primary vehicles. Physical gold is the purest form of the trade. You own the asset directly with no counterparty risk, no management fees, and no institutional intermediary between you and your wealth. The drawback is storage, insurance, and liquidity. Gold ETFs, with GLD being the largest and most liquid, give you price exposure without the physical storage burden. And they can be held inside retirement accounts, including IRAs, and 401ks where permitted. This is the simplest and most accessible route for most investors. The third vehicle is gold mining equities, and this is where the mathematics become genuinely interesting. If a mining company extracts gold from the ground at an all-in cost of $1,200 per ounce, and gold is trading at $4,800, their profit per ounce is $3,600. Now, if gold moves up 25% to $6,000, their extraction cost stays at $1,200, but their profit per ounce jumps to $4,800. That is a 33% increase in profit on a 25% move in the underlying commodity. Mining equities provide leveraged exposure to the gold price, which means higher potential returns and higher risk. If gold drops, mining companies get hit harder than the metal itself. This is not the vehicle for someone who does not have the risk tolerance and the position sizing discipline to manage that volatility. But for investors who understand the leverage mechanism and can size the position appropriately, mining equities have historically outperformed the metal itself during major gold bull markets. The position sizing rule that I will leave you with is this: size your gold position such that if gold drops 30% tomorrow, your overall portfolio is still intact and you are not forced to sell, because the investors who win in gold are the ones who can hold through the inevitable corrections within the larger trend, not the ones who buy at the first sign of momentum and sell in panic when it reverses. Risk management is not the exciting part of this story. It is not the part that goes viral or gets shared 1,000 times. But it is the difference between the investors who look back on the 1970s gold bull market and said they made 2,300%, and the investors who look back and said they bought in 1974 and sold in 1976 at a loss because they could not stomach the drawdown. Let me close with this, and I want you to hear it clearly. You now have more information about what drives major gold moves than the vast majority of investors in this market. You have the four signals. You have the historical proof across nearly 100 years, and you have a framework for thinking about positioning. What you do with that information is your choice, and it will say something definitive about the kind of financial decision maker you are. The people who saw these four signals in 1934 and acted made 69%, while their neighbors lost purchasing power. The people who saw them in 1919, 1971 and acted made 2,300% over the following decade. The people who saw them in 2008 and acted made 140% while pension funds were being quietly looted. All four signals are present right now. The debt mathematics have broken. The rules are being changed. Your savings are being robbed by negative real rates, and central banks are buying gold at the most aggressive pace in modern history. What you do next is entirely up to you, but understand this with absolute clarity. In 3 years, 5 years, 10 years, you will either be one of the people who saw this coming and positioned accordingly, or you will be one of the people who watched this video and did nothing. There is no third category. There is no comfortable middle ground. The money is either going to move toward you or away from you. And the only variable is the decision you make right now.